Howdy, y'all. Welcome to the Weekly Economic Update. I am Raymond Dolman, your humble host here at DSA Financial Group. And hope everybody's had a fantastical weekend out there. It was hot as hell here in Colorado. We had a couple days, and I live at 7,000 feet. So if it's up in the 90s at my house without air conditioning, it's a little unpleasant. So I know the Flatlanders down there in Denver were whining and moaning, it's over 100 degrees. But most of those places have air conditioning. Not out here. I mean, I'd say at best, half of the houses out where I live have some sort of central air. So anyways, like I said, hope everybody had a great weekend. Astros took 2 of 3 from the Athletics, which is always nice. Got a bunch of guys going to the All-Star game. A little sad that Jordan's got a bad wrist, but hopefully he's back in a few weeks and back good as ever. So anyway, so let's go ahead and jump in and take a look and see how the markets did today. A lot of red on our screen, but not too terrible. It was kind of, I know the Dow got close to break even and was in the green maybe for a smidge during the day, but not a whole lot. Excuse me. All right, the Dow Jones finished down 0.52% today, closed at 31,173. S&P 500 down 1.15%, closed at 38.54. NASDAQ was down 2.26. Tech really took it in the shorts today. Again, not surprising. It had such a huge rally after all that money creation 2 summers ago that it's really not surprising that tech is taking a beating right now. And tech closed at, or NASDAQ closed at 11,372. Small caps were down more than 2%. The VIX climbed 6.21% today. It's currently sitting at 2617. Moving on down, Canada was down 1.08, Brazil down 2.07, Mexico down 0.61. Moving on over to the European markets, Germany down 1.4. The UK was flat. It looks like they were open. France down 0.61, the Euro stocks down 0.99, Netherlands down 0.75, Spain down 0.43, Italy down 0.95, Switzerland up 0.11, Portugal up 0.09. Those are both basically flat. Belgium down 0.34. Let's move down over to the Russian exchanges. The MOEX was down 2.71, and the RTSI was up 0.83. Let's head on over to the Asian markets. Japan was up 1.11% today. Australia down 1.14%. New Zealand down 1.16%. Shanghai down 1.27%. The SESE component down 1.87%. The China A50 down 1.79%. The DJ Shanghai down 1.32%. And the Hang Seng came in down 2.77%. And the Taiwan weighted came in down 0.86%. So a lot of red on the screen. I mean, looks like most of them are down 1%, maybe less, but nothing too dramatic today. So all in all, it's a Monday. It's our first full week back after a holiday week last week, so not totally surprising. All right, well, let's go ahead and read through today's first, let's go ahead and read through the weekly economic update. All right. The week on Wall Street in a holiday shortened trading week, stocks rallied despite mixed economic data and vacillating energy prices and bond yields. The Dow Jones Industrial Average increased 0.77, while the S&P 500 rose 1.94. The NASDAQ Composite picked up 4.56%, and the internationals were 0.46% higher. Stocks move higher. In advance of Friday's much-anticipated employment report, stocks enjoyed successive daily gains despite ongoing concerns about a recession. Recession fears were supported by an inversion in the yield curve, which I've been talking about for a long time now. And updated second quarter GDP projections indicating the economy is ready to contract. Well, it contracted last quarter, so if it contracts this quarter, we're already in recession, technically. Technology shares were the big winners as investors appear to have turned to companies with earnings growth potential during a weakening economic environment. Stocks bounced along the flat line following the strong jobs report on Friday to close out a positive week. Employment's mixed signals. One of the holes in the imminent recession narrative has been the labor market strength. Historically, recessions have been preceded by or concurrently with a weakening jobs market. Friday's employment report reflected a jobs market that continued to belay Wall Street's recession fears. Employers added 372,000 jobs in June, a number that was above economists' estimates of 250,000. Wage gains were robust, a 5.1% year over year, though still below the inflation rate. So people are still losing money. The unemployment rate was unchanged at 3.6%. All right. Economic data coming out this week. On Wednesday, big report. The Consumer Price Index will be updated. Thursday, the Producer Price Index and jobless claims. And on Friday, retail sales, industrial production, and consumer sentiment. Got a handful of companies reporting earnings this week. On Wednesday is Delta Airlines. Thursday is JP Morgan Chase, Morgan Stanley, and Conagra Brands. Friday is United Health, Citigroup, Wells Fargo, BlackRock, U.S. Bancorp, and PNC Bank. All righty. So, good news coming out of last week. I have a white paper going out this week to those on my mailing list, Getting Disability Income. Hopefully you'll never need it, but I've known a few folks over the years who've had to collect SSDI, and unfortunately it doesn't go as far as you'd like, but it's nice to have a little something there. Now, if the federal government falls apart, which I have hopes that it will soon, because I'd like to get a 30% raise and quit donating a third of what I make to the federal government. But while we still have it, if you need it, it's good that it's there. Let's go ahead and jump in and read through this. If you cannot work due to a disability, you might be eligible for Social Security Disability Income, SSDI. These federal government payments could offer you a degree of financial relief. Most SSDI recipients get paid between $700 and $1,400 per month. This year, the average monthly SSDI benefit for an individual is $1,358. Your monthly benefit could range from $100 to $3345 based primarily on your earnings history. Roughly speaking, the greater your average annual earnings in terms of taxable income, the greater your SSDI benefit. Suppose you have previously spent some time out of the workforce, had jobs in which you did not pay Social Security taxes, or lived in a household receiving other government benefits. In that case, you can also receive SSDI payment amounts. How do you apply for SSDI? You can apply at the Social Security Administration's website, ssa.gov, or call the SSA at 1-800-772-1213. The SSA has a disability starter kit downloadable at ssa.gov to help you get ready for a phone call interview or to fill out the application so that you have the right documentation in hand when you apply. Once you complete and submit your application, it goes to the Disability Determination Office in your state for review. After that, the DDO sends you a letter notifying you whether or not you have qualified for SSDI. If you fail to qualify, you can appeal the decision in writing within 60 days of getting the letter. What are your chances of qualifying for SSDI? Typically, it would be best if you met the following criteria. 1, you must be currently out of work or unable to participate in what the SSA terms substantial gainful activity, meaning you can't earn something approximating a minimum wage by any means. 2, your disability renders you unable to perform your job or any other type. 3, your disability is expected to last 12 months or longer or eventually result in death. If you qualify for SSDI, the money will take time to arrive. SSA starts your benefit payments once you are determined to have been disabled for a full 6 months. So there's a 5-month waiting period that begins the first full month after your qualification date. The takeaway from this is obvious. There is no point in hesitating to apply for SSDI. You want to apply as soon as you can. There are 2 other important things to note about SSDI. If you qualify for it, you become eligible for Medicare just 2 years after you're entitled for benefits. Also, SSDI benefits adjust for inflation, so your monthly use is designed to grow larger with time. So there's some good information there. Hopefully you never need it. And I would recommend having some disability coverage that you own personally, especially if you're in a technical job or something that you're paid handsomely for. SSDI is not going to cover a lot of that. So I would probably recommend working with an insurance provider to have some long-term disability that you own and is portable, and take it with you wherever you go. And usually your employer will have some coverage, but it's usually not all that great. All right, well, let's go ahead and read through today's market recap. Stock market, Dow falls ahead of earnings deluge. U.S. stocks fell Monday as investors turned their attention to the start of the earnings season as And June inflation data ahead. Despite the strong job market, investors are still worried about a recession and are awaiting word from corporate chiefs about costs, supply chains, and their view on the next few months of business conditions. On Wednesday, investors will get the consumer price index print for June. Analysts expect a month-over-month rise of 1.1% and a 12-month rise of 8.8%. So it's going to go up even more than we've been seeing. Also weighing on stocks on Monday was the prospect of shutdowns in China because of COVID. Several cities are imposing new restrictions, including the gaming center Macau. This is weighing on casino stocks such as Las Vegas Sands Corp down 6% and Wynn Resorts Limited down 6.4%. Twitter Inc. shares fell 11% Monday as a social media company prepared to sue Elon Musk for his attempt to walk away from the $44 billion take-private offer. Musk, the CEO of Tesla, says he can't confirm the number of fake accounts on the platform. Twitter points to a 54.2 a share offer. Shares of Meta Platforms fell 4.7% after Needham downgraded the stock to sell from neutral. Investors have been trying to push stocks back up after a sharp sell-off in the first half of the year. Earnings season starting this week could help tip the balance. Another downturn could be in the near future if company reports fail to live up to expectations, Reuters reported. Big banks get things started on Thursday with reports from JP Morgan, Morgan Stanley, Citigroup, and Wells Fargo. Follow a day later. Investors are hoping to hear the biggest lenders' views on how well corporate borrowers are coping with inflation and interest rate increases. Yeah, so probably the biggest news was Elon backing out of his Twitter deal. I personally think he's doing this simply either to destroy Twitter or to clean it up and make it more of a free speech platform and get rid of all the woke scolds on there who get pissed about everything. I mean, these folks, the tolerant people on the left, they don't seem very tolerant if you don't seem to lockstep with their views on things. So anyways, we'll see what happens. I think in the end, he will either buy it at a much deeply discounted price based upon all their bots and trash they have on there and hopefully clean up the, what's the word I want to look for here in my head? Basically, certain groups of people can't say anything without getting in trouble. Other groups of people can threaten people's lives and no one seems to care. So, all right. Got an article here about commodities. Gold ticks down after dollars brush with new 2-decade high. With another strong U.S. inflation print seen in 2 days, the dollar flew a fresh 2-decade high on Monday, knocking gold a few rungs lower from its mid-1700 perch. Gold's slide came as the dollar index, which pits the U.S. currency against 6 other majors, plucked a new high above 108 since October of 2002. The dollar itself surged amid signs that the June print for the consumer price index due on Wednesday will show little retreat in inflation, with economists expecting an annual reading of 8.8 versus the 8.6 reported in May. The Federal Reserve's own tolerance for inflation is a mere 2% a year and vowed to raise interest rates as much as necessary to achieve that. Yeah, we'll see if the Fed actually sticks to their guns. Inflation itself should be positive for gold, given the yellow metal's long-touted standing as a hedge against price pressures and one of the best stores of value. But the dollar's rally on the back of rate hikes has helped the greenback steal the safe haven crown from gold. Rate hikes are an anathema to gold. Markets are preparing for the odds of the Fed imposing nonstop rate hikes of 75 basis points this month, and the next 3 if CPI does not retreat as quickly enough as the central bank expects by year end. Quote, inflation is playing a tug of war with gold and precious metals, is trying to hold the line. A hot inflation report on Wednesday will submit aggressive Fed rate hike expectations for later this month and drive up expectations for September's meeting. In quote, said Ed Moya, analyst at online trading platform Owanda. Quote, with Wall Street focused on whether the Fed will send this economy into recession, King Dollar will likely remain the trade, and that is difficult environment for gold, Moya added. Fed expectations for its July 27th rate decision will be submitted after the CPI report, and signals from Wall Street banks on whether the U.S. consumer and the economy were weakening faster than most earnings estimates are implying. As though on cue, the New York Fed said on Monday that more than half of the consumers it surveyed for this month declared that their household financial situation has deteriorated from a year ago, and nearly half expect it to worsen in 2023. Yeah, that's kind of been the puzzling thing. As over the last 2 years, the dollar index has gone from, the low 90s, even I think 89 point change on a few dates when things were getting so bad right after the whole Corona stuff. But, I'm a little shocked that the dollar has gained so much strength. But what it really tells me is that the other central banks around the world are probably, and it is confirmed. You can go to things like Yardeni Research and see all the balances of the other central banks and their, what they've money creation that they've done. So basically, they've done the same things that our central bank has done: print money, buy up toxic assets, and they just done it to a worse extent, evidently, because their number or they're comparing their currency to our currency, ours seems to be winning out. So again, it is a little bit of a surprise, but I don't know. Looking at it long term, do you think that the dollar is going to remain strong with all the dumb decisions that, people in Washington have been making over the last 2 years? I don't think so. I think in the end, gold will probably win, or gold, silver, and other commodities are going to be your, a good hedge against the inflation that we're feeling now. And then, however long it takes to recede over time. So, all right, got an article here from Zero Hedge. One bank warns to brace for a huge CPI surge, but it's all downhill from there. This Wednesday's CPI release should show that what UBS calls another huge headline CPI release in a note published by its U.S. economist team and available to pro subs. The Swiss bank projects the second largest seasonally adjusted monthly CPI rise in 40 years, a couple basis points above March this year, and only behind September of 2005 at 1.26%. The UBS CPI projection is above the current Bloomberg consensus of 1.07, and the bank's forecast for June NSA CPI level at 296.101 is about 8 basis points higher than recent CPI swaps fixings. While energy prices account for more than half of the June price jump, with gasoline prices rising 11% compared to May, according to AAA, retail gasoline prices peaked on June 13th and have fallen 22 cents per gallon over the past 3 weeks. Wow, that seems huge. I mean, 11 cents would be huge if gas was $1, but alas, it's not just gas. Outside of energy prices, UBS expects that the June CPI to show large increases in prices for food, new and used vehicles, rents, as we have warned a year ago, and airfares. Energy and food prices aside, and focusing on core prices, UBS projects that the seasonally adjusted core CPI moved up 57 basis points in June, just a few points above the average increase since October. The bank expects that 1/3 of the strong June core price increase will be from airfares and motor vehicles, which, however, it believes will ease notably in coming months and do not provide much signal for future inflation. Specifically, CPI airfares are projected to have risen another 3.75% in June, according to Hopper. Actual domestic airfares peaked in mid-May and have dropped roughly 15% since then. For new and used vehicles, prices are rising strongly, but production has picked up, and that higher production should also begin to push vehicle prices down in a few months. Instead, UBS suggests paying greater attention to the following 3 categories. Owner's equivalent rent, OER, increased 60 basis points in May after 8 months in the 40 to 45 bips range. Was the May jump a one-off or the start of even higher increases? For one answer, again, read this. And there's a hyperlink there if you want to read it. This is linked in the show notes. It is likely that much of the May jump was persistent, and UBS has penciled in a 55 basis point increase in OER for June. That said, rents for new leases slowed starting last summer, and the usual lag suggests the peak monthly increase in OER was either May or will occur in the next few months. Next up, core goods outside of transportation. Prices for non-transportation core goods have contributed notably to the rise in inflation over the past year, but have slowed substantially since the peak monthly increase in January. Here too, a question in whether core good prices become a drag on inflation. Unlike us, we are confident that bullwhip effect driven liquidations will lead to a big price drop. UBS expects core goods prices will continue to slow, but will not yet become negative. Next, core services outside of shelter, medical, and transportation. Rising wages could force greater increases in this relatively persistent category, but the trend has not been clear in recent months. Looking at full year data, consensus is emerging across most Wall Street banks that inflation is projected to peak at 9%, with the June CPI before starting to decline with falling gasoline prices in July. Core CPI inflation, in contrast, peaked in March at 6.5%, is projected to have edged down to 5.8% in the June release. The monthly pace of inflation is expected to slow notably over the remainder of the year, though July and August CPIs should see core inflation temporarily rise back up to 6%. UBS is not the only bank to forecast that inflation has now peaked. In its own take on inflation and the current state of global economy, Goldman agrees with UBS that the headline CPI is likely to show another 40-year record in June, but at the same time, the combination of slower growth and reduced supply chain disruptions has increased Goldman's confidence that underlying inflation pressure will indeed come down in H2. This, even as Goldman's commodity team projects a rebound, although the recent declines in wholesale and retail gasoline prices suggest that energy impulse to sequential headline inflation will be negative in the next couple of months. There's another, more reasonable explanation for why inflation has peaked, even as Goldman now admits, repeating what we said last December. The Fed's relentless jawboning of ongoing 75 basis point rate hikes has fueled concerns that the Fed officials have become so determined to whip inflation now, which was the slogan back in the that was, I think, Ford, whip inflation now. They had these win buttons that people wore on their for campaigns. Didn't work out real well. Inflation lasted another 4 or 5 years. Where was I? All right. That they will end up triggering an avoidable recession. Well, yeah, we could have avoided this if we didn't print $6 trillion 2 summers ago, shut down the economy for an extended period of time. But hey, we didn't all die from a cold. Thus, markets now project meaningful rate cuts in 2023, and the five-year forward break-even CPI inflation rate has fallen to 2.1%, consistent with PCE inflation of 1.8%, given the historical gap between the two measures. For what it's worth, Goldman has kept its terminal funds rate estimate of 3.25 to 3.5 unchanged since the Wall Street Journal article that foreshadowed the 75 basis point move. However, the bank now expected this rate to be reached as soon as year-end, with another hike of 75 basis points this month, 50 basis points in September, and 2 final 25 basis point hikes in November and December. Finally, perhaps the simplest confirmation of global inflation is now peaked comes courtesy of the Citi G10 Inflation Surprise Index, which peaked in March and has since declined. You can see that right here. All right, well, we shall see. My own personal view on inflation is that once energy costs come down to a reasonable level, we'll then see a trickle-down effect into the rest of the economy, because energy affects everything. It affects, driving to work, turning your lights on, cooking food. Everything you do, energy affects it. So when energy is expensive and until those prices recede, we probably won't see a lot of help everywhere else. But, again, I could be wrong. That's just my own 30,000 foot macro view of things. All right. One last article comes from our friends at First Trust, Mr. Brian Westbury, their chief economist. Mortgage reset alarmism is off the mark. Let's go ahead and read through this. Some investors think the U.S. is already in a recession, as we wrote 2 weeks ago, and as recent data have confirmed, we don't think that's the case. Industrial production is up at a rapid pace so far this year, while payrolls have expanded at a monthly pace of 457,000, and unemployment rate has dropped to 3.6 from 3.9. Real gross domestic income, a companion to real GDP that is just as accurate, but which arrives a month later, rose at 1.8% annualized rate in Q1. Nonetheless, the recession story is out there, and some claim adjustable rate mortgage resets are going to knock the economic legs out from under consumers. The idea is that with the Fed raising rates rapidly, as the rate on adjustable mortgage resets, homeowners are going to have to make higher payments, which means less money to spend on other goods and services. Let's start off by noting that the most basic problem with this theory is that even if mortgage resets increase some families' payments, the holders of these mortgages will get the extra payments and their purchasing power will increase. On net, purchasing power should remain unchanged. But to be cautious, let's indulge the reset theory by pretending the extra payments are money that just disappears with no one on the other side of the transaction. Even then, our calculations show the theory doesn't add up. Households have about $12 trillion in mortgage debt, according to the Federal Reserve. So yes, the top line number sounds scary, but according to the Federal Housing Finance Agency, only 3.7% of these loans are adjustable, or about $450 billion. Now, let's say 1/3 of these mortgages reset every year. That's $150 billion worth of mortgages resetting. Still a big number, still potentially scary. But when we calculate how much a reset would change the payments on these loans, the problem suddenly gets much smaller. Adding an extra 2 percentage points in interest on $150 billion in debt is $3 billion. Obviously, people making these extra $3 billion in payments won't like it, but the extra payments equal only 0.018% of annualized consumer spending. That's not a typo, not 1%, not 0.1%, but only 0.018%, which means that even if all of the $450 billion in adjustable rate mortgage reset upward by 2 percentage points at the same time, we'd be talking about 0.05 of annual consumer spending. The bottom line is that we think a recession is eventually on the way because monetary policy will have to get tight enough to wrestle inflation back down and should be tight enough to cause a recession starting in late 2023 or beyond. But those rate hikes won't work like they did in 2006 and 2007 when nearly half of all mortgages were adjustable in 2005. The mortgage reset story makes superficial sense, but when you work through the actual numbers, it's not something to worry about. All right, so yeah, I mean, it's bad news, but it's not the worst news, is that it is a small amount of the mortgage business that is in adjustable mortgage. I think people probably learned a valuable lesson. Don't have an adjustable rate mortgage when you're potentially heading into an upward trend. So, all righty. Well, that's everything I had for today. If anybody needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And if you need, I'll be back tomorrow with the Liberty Call. So I'll see you guys there, and y'all have a great evening. Bye-bye.